Welcome back. You're still tuned into Markets at Lunch right here on ET Now. And let's now put the spotlight on India's gold financing industry. Gold prices have declined nearly 15% since the Israel-Iran war broke out. And the fall in gold prices is now posing a risk to India's gold financing industry. Fitch Ratings has come out with the latest report, and it says that an extended correction in domestic gold prices will test the effectiveness of Indian gold-backed lenders' risk controls, particularly for loans that originated when gold prices were at near recent high levels. Remember, a sustained decline in gold prices could translate into higher delinquencies and more frequent auctions if falling collateral values coincide with weakened borrower cash flow. To understand this in greater detail, we are now joined by Mr. Siddharth Goel, Director of Financial Institutions at Fitch Ratings. Mr. Goel, afternoon. Thank you so much for taking your time out and joining us here on ET Now, and wanted your initial assessment of what the fall in gold prices could actually mean for gold financiers back home in India. How much buffer do you think current loan-to-value norms realistically provide before lenders actually start facing some amount of stress when it comes to gold financing in India?
Sure, thanks for having me here. First of all, yes, you're right. The gold prices have come off significantly by more than 15% in the last month. And an extended decline should start testing the risk controls of gold loan NBFCs, particularly for loans originated in recent months when gold prices were near highs. Now, gold loans have been subject to regulatory loan-to-value limit of 75% on the loan principal at origination. This implies sufficient buffers to absorb a 25% gold price decline before a principal loss. Also, the effective loan tenors of typically 4 to 6 months reduce the actual interest burden on borrowers. In practice, the average origination LTVs are typically up to 5% below the regulatory limit, although this widened up to 10% as gold prices climbed in past 12 months. While at the same time, the last reported outstanding LTV ratios of gold portfolios of key lenders offer sufficient buffers to absorb the gold price decline with LTV ratios at below 70%. The collateral valuation is based only on gold content of jewelry, excluding gems and making charges, which imply a higher replacement cost and a potentially larger valuation buffer relative to these reported LTVs. Therefore, all in all, we don't see an immediate material fallout of recent decline in gold prices on the collateral buffer. This is despite rising gold prices boosted collateral buffers on outstanding portfolios. However, a continued and prolonged drop can erode these buffers, which can trigger accelerated gold top-up requests from borrowers. This may also raise operational complexity and regulatory compliance risk for NBFCs.
Right. So for now, you are telling us that perhaps we will not see any kind of immediate impact because of the buffer that these companies have been sitting on. But also wanted your thoughts on what could the worst case scenario be if at all gold prices were to fall further. Say, for example, if they were to fall by another 15 to 20%, then do you think the industry could come under some bit of stress?
Yes, that's right. Sustained decline could translate into higher delinquencies and more frequent gold auctions if falling collateral values coincide with weakened borrower cash flow, especially in a tricky economic situation for SMEs. As for impact on gold NBFCs' profitability due to this, their net interest margins, which are typically high, will be an important shock absorber. Also, adequate recovery of principal through auctions generally restricts credit losses. But these could also come under pressure if higher delinquencies coincide with the sharply weaker gold prices, which can raise risk of insufficient auction proceeds to cover accrued interest or at worst the principal.
What do you think investors should look at this point in time? I understand that the situation at the moment is not as grave. But what are some of the other indicators that we as investors need to watch out for in case gold prices fall further?
Absolutely. I think you should look at the strategies of various NBFIs. Like, for example, NBFCs with more conservative origination when prices were rising rapidly, better margin call execution, and greater discipline in auction practices, they should be better positioned to manage this volatility. At the same time, conversely, NBFIs with aggressive growth near peak prices, thinner earning buffers, or weaker remediation capability may face higher LTV compliance risk and potential profitability pressure if gold prices decline further.
All right,
And
Mr.
as regards, I'll just add, as regards, the Fitch's ratings on gold loan NBFIs are concerned, they do not hinge on collateral price fluctuation as such. Still, significant asset quality, earnings, or capital weakness as gold prices correct may indicate aggressive risk practices that could pressure ratings.
Mr. Goel, do you think, given the volatility that we have seen in gold prices of late, these gold financiers could perhaps go ahead and increase the LTV to ensure that they have adequate buffer? Or do you think the government actually could come out with some kind of measure to ensure that delinquencies continue to remain on the lower side?
So, there are new rules. RBI has come out last year with new rules on gold lending, which should actually standardize the procedures, which should reduce compliance risk of this sector. So, I don't think so. Gold lenders would increase the LTVs because from today onwards, the new rules would come into effect. Although the Gold Association has asked for a deferment of these rules by 6 months. But these rules should bring propriety in this segment, which includes LTVs to include interest portion for bullet loans. LTVs have to be maintained throughout the tenor, the LTV differentiation on ticket size basis. So all in all, I think our regulatory framework is strong enough to ensure that lenders per se do not get into any kind of territory which might entail higher risk for their portfolios.
Right. And at this point in time, what do you think the gold financing companies are doing or should do in order to ensure that even if gold prices were to fall further, the sector actually does not face any kind of negative impact of fall in gold prices?
I think they should continue to monitor the gold prices. Many of the large entities typically have real-time assessment of the LTVs. They should ensure, the margin call execution to be pretty streamlined. Greater discipline needs to be followed in auction practices. So I think they should be better positioned to manage this volatility if they are able to manage this volatility, if they're able to manage this period pretty well.
Clearly, so everything depends on how gold prices move going forward. But Mr. Goyal, thank you so much for taking your time out and joining us here on ET Now. And he is perhaps saying that the impact on gold finances, at least at this point in time, is limited.